Welcome back to the Global Digital Asset Regulatory Summit. That is a mouthful, particularly at 2:00 p.m. Australian time, and I'm sure it's a lot later or a lot earlier for you as you tune in overseas. We're going to jump into taxation and the tax settings here in Australia.
Thanks, Amy Rose. Welcome, everyone from around the world. My name's Greg Fales. I have a wonderful panel that's going to make crypto tax very interesting. Very capable people, in fact, and I'll just get straight into it without further ado. I've got Joni, Maryna, Christina, and Shane. You know they're well credentialed in Australia and globally as well. I'm going to start off with Joni, crypto's leading tax lawyer and our go-to. Joni, I wanted to start off with how can crypto tax record keeping and compliance be solved with agentic workflows?
Thanks, Greg and Amy Rose and team for putting the event on and having us here today. I have struggled with my own crypto tax records since I got into crypto. And as a tax lawyer, you'd think I can crack it, but it's still a very manual process that if we don't have legislative tax clarity, we can't necessarily optimize or fully automate what we're doing. And so some of that has held me back. I would be doing more crypto activity if it was easier on the tax compliance side and I had more certainty about, what's going to crystallize gains or not. So I've had my practice as a crypto tax lawyer for the last decade, but have myself launched a separate software company that helps simplify the process of getting AI agents to work for you, but combined with automations. So I just wanted to plant the seed here, and people can start testing this already to improve their tax record keeping. But just looking at workflow builders and Crystal Workflows launches in October, but we can start to pull blockchain records. And one of the key things is in record keeping, the ATO has an informal position that going back to a block explorer or relying on blockchain records is not a tax record. So it does not constitute record keeping for tax purposes. And it just blows my mind because it is the immutable ledger. It's a thing that you trust. But what they're actually wanting are time-stamped PDFs of what the block explorer is showing you. So when you do an Ethereum transaction, you can quickly see on Etherscan the transaction details. Now, I've been manually PDFing that and telling all of my clients to do that to make sure that they're properly keeping the timestamps records and able to recover the data as well as there's more detail that you do to regularly pull down CSVs from exchanges that don't have integrations with the likes of Shane's software, the CryptoTaxCalculators of the world. So once you can automate the collection of those PDF records, you can also use AI to help you get insights from those records to say, well, I might rely on them to say, you've got 100% compliance score for your tax record keeping this financial year, because for all of your wallet activity, you've got all of the primary sources that support all of your activities. And this becomes even more important from an SMSF and a business perspective, where especially if you're subject to audit requirements and completeness to prove that transactions happened, you've got those primary sources. So that's a really low-hanging fruit one that a lot of people probably aren't PDFing, the Block Explorer transaction details, because if you've got thousands of transactions, it takes too much time to do. But this is something that AI can help you do, and we've got a workflow specifically for this. I would just say there is still a lot of tax complexity, even though we've had some sense of regulatory clarity today. It hasn't filtered through on the tax side. We don't have tax clarity. But the silver lining is if there is a specific way in which digital asset platforms and tokenized custody platforms have to hold assets, such as through a trust structure, the big sleeping issue that I'm going to be looking for tax clarity on is historically. So if there actually has been a disposal of tokens when you send tokens onto exchange, which is a taxable event, everybody pretty much doesn't treat it as a taxable event, but there's going to have to be look back or transitional relief if the ATO doesn't intend to enforce and collect on what taxable gains may have occurred from transferring tokens into what will now be called digital asset platforms. So
Thanks, Joni. I think that's absolutely fantastic. That's we might move on now to Christina, Dr. Christina Allen at Curtin University, who's formidable in law as well, in the tax world and globally. Christina, what's the brief overview of the resolved and unresolved tax issues surrounding crypto assets?
I will give you a brief overview of where we're at in terms of scholarship and practice. So firstly, I would like to thank you to let me join today's session. This year, we celebrated Bitcoin's 16th birthday. 16 years ago, Bitcoin began as what many called a monetary experiment. Today, it has sparked an entire universe of crypto assets and in the process created more tax questions than almost any development in recent memory. So what I'd like to do today are three things. First, look at how tax authorities initially try to classify crypto assets. Second, walk through 4 ongoing debates that are still unresolved. And finally, reflect on what this all means for tax design going forward. So the first question sounds straightforward. Are crypto assets money? Most tax systems said no. They are not legal tender. Their value swings wildly, and governments were reluctant to give them legitimacy. Still, in VAT and GST, crypto assets often are treated like money, largely to avoid double taxation. For income tax, countries went in different directions, sometimes calling them intangible assets, sometimes property, sometimes commodities. And each choice has practical consequences. In some countries, you can claim certain exemptions, in others, you can't. In Australia, Bitcoin has been confirmed not to be foreign currency, so it generally falls within capital gains regime or trading stock rules, depending on how it's used. Australia also recognises the treatment of cryptos as personal use assets for tax exemption purposes, but such treatment is not allowed in South Africa, for example. Now, stablecoins are now forcing a rethink. They look and act a lot more like foreign currency, yet most tax systems still group them with other crypto assets, which could create problems as their use expands. So moving on to the 4 issues that are unresolved, 4 areas of issues. First, mining. When miners validate transactions, should their rewards be treated like business income taxable immediately or like a windfall taxable only when sold? The US tends to tax on receipt, drawing on the Glenshaw-Glass principle of accessions to wealth. Due to the increasing resources for successful mining, many countries now also treat the new cryptos received as business income. However, some countries lean towards waiting until disposal, treating mining more like digging gold out of the ground. Australia takes a hybrid approach, immediate income when mining is carried on as a business, but disposal treatment for hobbyists. Second, staking. Proof of stake systems reward users who lock up tokens as collateral. Most countries treat tax rewards when they are received, but should direct staking be taxed like self-created property only on disposal? And should indirect staking through exchanges be treated more like interest? This is still up for debate. Third, hard forks. When a blockchain splits, token holders suddenly own assets on 2 chains. The US treat that as income right away if you have control of the new tokens. Most other countries wait until the tokens are sold. Scholars have compared forks to corporate splits, stock splits, even to carving a cow, but none of these analogies fit perfectly. Fourth, decentralized finance or DeFi. Here, crypto is pledged as collateral through smart contracts. In strict legal forms, this creates multiple disposals and taxable events, but treating them that way is often impractical. Some tax authorities are exploring a substance over form approach, borrowing from rules for repo or securities lending. But a tailored regime for DeFi has not yet emerged around the world.
So,
Now,
Christina, I might just keep going if that's in, hold your power on that, but that is so fantastic in terms of our global aspect of it. I might move on to Maryna, who's also a very well-regarded tax accountant and software developer. Maryna, could you tell us what are the most common mistakes or blind spots you see from taxpayers and accountants in crypto reporting?
Yeah, so it's been 11 years since the tax office declared to everyone that Bitcoin is taxed. However, there are still a lot of myths in terms of public and investors, what they are thinking in terms of tax. So number one is about the capital loss. If I have a capital loss, then it's maybe not that important to declare on my tax return. That would be the thinking. However, that can lead to a review or audit, because as we know, the tax office gets information from the exchanges, and that would be a trigger because non-declaring anything is also a problem. So avoid that one. Myth number two is happening quite often when a taxpayer collaborating with a tax agent, and they would be saying that, okay, I need to do my tax return for 2025. I just send you all transactions for 2025 financial year. However, when we calculate the capital gain, we do need the history. And quite often you maybe purchased something that was like 4 or 5 years back. So that still remains a challenge to explain to everyone that keep the history no matter what until perhaps you just realized all your portfolio. And myth number three is if a taxpayer has a lot of transactions, so let's say an investor has 1,000 transactions, that can catch even professionals. They may immediately think that it must be a trader. However, in a tax, it may look like, but in our industry, in crypto, it's so easy to end up with dust attack or worthless airdrops, potentially unidentified spam, and rewards like staking income. So it's normal for an investor to have a lot of transactions in some cases. And we still need to assess based on factors rather than transaction count. There are also some niche myths. For example, a lot of taxpayers and professionals may think only about a trader and an investor as the two concepts. However, there is a third one when it's a profit-making undertaking, and that can be overlooked. It's a niche because it can be usually linked to a business or skill on the side. And the last but not the least is also can catch auditors when we talk about SMSFs, like self-managed super funds. If a client, let's say, was scammed and lost some crypto in their SMSF, auditors sometimes think it's an early super release. Well, it's definitely not, because there is no benefit for being scammed. And it can lead to a breach in some cases if the trustees are not having any documentation around investing into crypto, of course. But usually it's not. It's just a tax loss and accounting loss.
Thank you, Maryna. That's very, very informative. Can I introduce you to Shane Brunette? Shane is the CEO of CryptoTaxCalculator, which is a leading software that a lot of accountants use. Shane, welcome. Where do taxpayers and advisors typically struggle with maintaining accurate crypto transaction records?
Yeah, thanks for that, Greg. Yeah, it's interesting. A lot of crypto users come unstuck when it comes to doing their tax, just trying to gather up all the records in one place. if you think about crypto and how that compares to, say, equity trading, in crypto, it's very common for individuals to go on a journey, I suppose, where they are introduced to perhaps a local platform, an Australian-based exchange, and then they might move on to an international platform and then into on-chain activity. And what they end up with essentially is many different accounts, all these different networks that they're interacting with, and all the dApps on these networks are in a way different trading platforms or accounts that they need to consolidate into a centralized location so that they can work out what their tax impact might be. And that's actually quite a painful process. A lot of individuals, they might forget what they've been using, especially over the years. And if they haven't done their tax for a few years with crypto tax, that can cause a lot of problems, just trying to remember what you've been doing. And then a lot of individuals don't realize that they truly do need to input all of their transaction history from all these different platforms. For example, we did a study with over 1,300 neutral participants, crypto users who are quite active, and 70% didn't realize that their self-hosted wallets and the activity on these self-hosted wallets might in fact be taxable. So that's it's more than half. It's a lot of people out there who are doing a lot of activity on chain and not even realizing that it's something to be declared, and that potentially the ATO does have visibility over this because it's all printed on the blockchain ultimately, and you can go back and look at it at any point in time. So gathering up all these records is arguably the biggest challenge, getting it into a centralized location, getting it normalized into a format that your tax professional can understand and make sense of. This is the real challenge. Once you've got it in a standard format, you keep it up to date, then it's a lot easier to go out and get the right tax advice to understand your tax impact. But it's very hard for anyone to help you if even you don't know what you've been doing over the last few years. So that's definitely the biggest challenge.
Thanks, Shane. Just cognizant of the fact that we've got 10 minutes left, and I want to ask the panel, and I want to go through, just cognizant, probably got 2 minutes each. So Joni, all of you give me a series of wonderful questions. Joni, what's the most important salient point you want to get across today to people globally? I mean, I know you talked about the tax board recommendations. Could you provide us what you think is the main message you want to get across today?
Well, the Board of Tax report, which was summarising the review of taxation of digital asset transactions, that came out earlier this year. The key recommendation practically is for the ATO to form a crypto tax task force. And I would just encourage, I know everybody is fatigued. There's been a number of consultations. You've probably whinged to your accountant every year for the last decade, but I think that the ATO task force that is going to form, and there's industry practitioners invited to this task force, this is where we've got momentum, political will, and a dedicated task force to finally take up the tax issues that are holding us back from doing more crypto activities on chain. So even if you're fatigued, I would just encourage you to poke your ears up, follow each of us on the panel today, because we'll be sharing on social media when we need your help to understand the most pressing tax issues to you, and also your ideas on how we might practically solve them. So really just a soundbite for the asks that will be coming over the next months to come.
A great point. And also for those of you wanting, DECA also has a tax group that provides some output. So please, we're welcome to join that. Christina, couple of minutes. What's the main salient point that you want to get across during this message today?
Well, across all the substantive tax issues, we are seeing more emphasis on enforcement and compliance, and the OECD's, crypto asset reporting framework is one sign of this shift. even if we don't have perfect answers, governments want the information to ensure crypto isn't slipping through the cracks. And when it comes to, the global trading kind of scope, while global uniformity may be out of reach, clarity and administratability are within reach, and that may be enough to keep the tax systems functioning as technology evolves.
Fantastic. Maryna, you recently participated in the 2025 Tax Summit in Melbourne. What are the key takeaways and how has the ATO approach to crypto taxpayers evolved recently?
Yeah, so it's important because not many people know that Australia is one of only 8 countries in the world that is actually transparent about the tax gap and about observations and the focus for the audit. We're also unique in a way that only Australia and the UK is doing this report every year. So this year, the Commissioner of Taxation was actually focused on this report and was saying that in October 2024, there was a release for 2022 financial year where we see the gap of 7.5%. So it's not large, sounds like. However, it reflects in 44.5 billion Australian dollars. And the part of it, a large part, over 60%, belongs to SMEs, sole traders and individuals. So there is a big shift because the wealthiest, the richest 5,000 group have been already audited, and the Commissioner is quite happy with the outcome. There is a lot of work, but there is still outcome that now we have to focus on small players. So I'd say that we have to be audit prepared, and the middle class may get audited. That's the message this year. And communication within the ATO has changed significantly. So we used to receive audit would be like a formal letter, or even a review would be a letter, and specific information would be requested, and there would be links to like voluntary disclosures. Nothing like this happening these days. We just get an informal chat message from the tax office. And a lot of taxpayers may get caught up by thinking that, the ATO is friendly. They're talking like my friend. And they do talk like a friend because the communication has changed. However, it's still the first step to the audit. And internally in the tax office, the audit is like triage, basically. There would be first step, this kind of message. Second step, see what you would respond. And just sending to them a bunch of documents is maybe not the best approach. It's very important to clarify and address everything. And while it's good that the tax office is more simple in communication, because we don't want maybe to simple people just not being able to understand even the request. However, it does create that perception that maybe it's not that complex. So don't get tricked by the communication message. Be formal, take it seriously, and don't take it lightly. Definitely record keeping is the key.
Thank you. Thanks, Maryna. Shane, what does good look like when it comes to software-driven solutions for tax compliance and reporting?
Yeah, so backing onto Maryna's point there, the risk of audit is increasing. It's a global, I think, an acknowledgement for all these different tax authorities that crypto is not going away and the tax gap is real and they're looking to close that tax gap. So it's very important to have accurate records in place to all your activity. So if you are getting a message from the ATO, you're able to present that information in collaboration with your tax professional to get any questions answered. You'll be in a lot better place compared to not doing anything. So it's just really essential that you've got all your records in place. You're getting the right advice about that activity that you've been doing, and if somebody comes knocking, you're fully prepared.
So I'll just open this to the panel. Is everyone seeing increased tax office activity in this area?
Yeah, we're seeing it globally as well. It's multiple
Yes.
different jurisdictions looking to get more information from exchanges and combine that with on-chain activity. So yeah, certainly from this side of the table, we're seeing more and more audits.
Yeah, and also voluntary disclosures. I've had the highest number ever in the last 12 months of individuals finally picking up the last 4 or 5 years or more, and saying, I finally want to get it sorted, and I'd love to be under the voluntary disclosure program. So people are self-selecting too. They're trying to come forward and clean things up, which is highly recommended.
Highly recommended. Now I've got a couple of minutes left and I'll just go briefly. I know there's a couple more questions, but Joni, what are the key challenges and opportunities of CARA implementation and cross-border due diligence? Mindful, we've only got about a couple of minutes.
Just to say, we don't have a clear effective date for CARF in Australia, but once Australia signs on and starts collecting data, it can also get data from other tax authorities. So the picture that the ATO is going to have before they even approach you, the ATO can do very comprehensive desktop audits now. So that increases the risk of default assessments, which come with automatic penalties. All the more reason to just get your tax compliance sorted quickly.
Fantastic. Christina, international models of crypto taxation provide useful comparisons with Australia. Just a minute or so on that, or half a minute.
Sorry, what was that?
It's the international models of crypto taxation provide useful comparisons for Australia. What is it globally that you think?
I think definitely there is increasing well, the point that people are considering is the international aspect of the administration rather, and that's definitely on the horizon. To what extent it's going to be achieved is still questionable, and yeah, so yeah, it's an area that we need to watch out for.
Thank you. Maryna, what's the most common blind spots that from taxpayers and accountants and crypto reporting?
Well, I see that for crypto investors, they sometimes have a mission, right, and a goal. And it can be, I want to make 1 million in crypto. And why not? We are in crypto, ladies and gentlemen. So that's great. And let's say they realize they have actually that 1 million gain and they do want to pay tax. There has been a tax attached and calculated and paid, and then they have a bit of disappointment. So I'd say that everyone should dream big. So I encourage everyone to envision 2 million so that
pay the tax. That's exactly right.
Yeah. And
thank you.
it will be great.
Yeah, Privilege, thank you. And Shane, to finish off with you, this is very important in terms of how does tax software best keep up with the fast changing regulatory requirements?
Yeah, I mean, there's a lot going on out there with constant updates from different tax authorities. Just a lot of collaboration with the industry, with other accountants, as well as tax authorities. That's the path forward. We're doing a lot of that overseas now and excited about the Crypto Tax Working Group in Australia.
No, fantastic. Joni, I might leave with you. Have you got a summary in terms of this session?
Well, 3 of us, Shane, Maryna and I each have software products in the market. So it's just a sign that to practice in this space as a professional that needs to keep up and act at crypto speed and do the best for their users. Like, it's not enough to just use traditional tools anymore. We need software from the likes of people that live and breathe the space and are using it, which is each of us on the call. And Christina, I'm sure you've got a way at university to do it. But really, we hope that there's tax clarity coming in Australia, but we can help infuse that agenda, especially through the Crypto Tax Working Group and talking to DECA. So please reach out.
Now, I haven't been told to get out of this, so I think we've still got some time for anyone that's got a topic. And
No.
I think she's about to start.
I'm just trying to be as polite as I can, and I do really appreciate all of your great great, brilliant minds coming together, and I was trying not to interrupt. So, but I had to at the end.
Excellent, excellent. Thank you all. It was a wonderful panel. Collective of really people that have been in the industry for a long time and are wonderful to be part of it. Thank you, Amy Rose. You know, you do a wonderful job with DECA, and we're all proud to be part of it.
Yeah, what is it? Teamwork makes the dream work.
That's it.
That's what we're doing right now. So thank you so much. Appreciate it.
Thank you. Thank you all.
Thank you, everyone.
Thank you. Really appreciate it.